The Bank of Ghana says lending indicators of economic activity during the first quarter of the year suggest some slowdown, reflecting the restrictions, social distancing, and the partial COVID-19 lockdown measures introduced by the government in the middle of March. Joining me from Accra to discuss how Ghana's economy has performed so far is Courage Kingsley Martey. He's a senior economist at Data Bank. Thank you so much for your time today on the show, Courage. And I'd like to first understand, your assessment of how the government of Ghana is handling the COVID-19 pandemic.
So they've done very well, creditably, from the health perspective to the economic perspective. The government has tried to limit the human and economic cost, and to the extent that they are faced with revenue mobilization concerns since 2016, and the fact that there's been growing pressure to spend on critical sectors of the economy, having moved the budget around and looked for concessional funding as well as less expensive fundings, then also tapping into central bank financing. I think they've tried to manage the shortfall in revenue with concessional funding, which is quite creditable to that extent, as well as the health side as well, trying to take measures that would have adverse consequences on the economy, though, but then try to limit the spread of the virus and save a lot of human life.
But how has this played out on the key economic indicators for Ghana? Talking about the GDP, talking about inflation.
Well, the impact is still evolving, but from at this stage, it's quite devastating. We saw inflation jumping significantly beyond the upper band of the central bank target of 6 to 10%, hitting 10.6%. And that's a direct consequence of the economic lockdown or 3-week lockdown we saw in April, where there was an increase in demand for consumables, which led to an increase in food prices. And so that has its impact on pricing at the moment, and we are yet to feel the full impact. We expect inflation to peak over the next 2 months. Then also we've had some pressure on the constraint to economic activity from the production side as well. Supply chains have been disrupted as well because of the lockdown, because of the limited access to financing by critical sectors of the economy. So from financial sector, monetary sector, fiscal sector, and the real sector, as well as the external sector, there's been a hit across the board.
All right, now let's look at how this has put a strain on the government's budget so far. When you look at some of the key commodities that make up Ghana's mainstay, we're talking about cocoa, we're talking about gold, and even the Brent crude. I'd like to know how, based on this commodity, the fluctuations we've seen in commodity prices, that has impacted the books in Ghana.
Well, it's been really difficult. First of all, crude oil currently accounts for about 6 to 7% of government budget, and so that has to some extent some impact on the budget. However, the main impact will come from international trade taxes and domestic VAT collections, because they account for a significant chunk of government revenue. As a result of the slowdown in global trade, as a result of the slowdown in domestic economic activity, VAT collections suffered significant downturn. And so in the first quarter of this year, government recorded a deficit of 3.4% of GDP against a target of 1.9% deficit. And already the primary balance is in deficit. And so it tells you that even the government books is hard hit. And so as we get into the latter part of the year, things are not looking very bright. And so the deficit could even widen beyond the provisional estimates that we have currently.
All right, but looking at the monetary policy response, though, I understand the Bank of Ghana recently kept its policy rate unchanged. And I'm trying to understand the kind of wiggle room you have for monetary policy to deal with the pandemic.
Well, so the understanding at this point, and I would imagine, is that you cannot continue to use the interest rate channels again, because the banks who are supposed to help stimulate credit to the real sector are also cautious because MPLs have started to go up. And so what you now want to do is to deploy unconventional means. In Ghana, we had an MOU where central bank is not supposed to finance government budget because of the inflationary consequences. But now what the central bank is trying to do is to reduce their reliance on interest rate channels and go more towards government funding so that they would be able to inject quick liquidity into the system. So I would imagine that the interest rate room is very limited because the banks themselves are very cautious of high NPLs, weak asset quality, because credit risk has become elevated. And so the option now is to rely on government funding to stimulate growth in the real sector.
All right, but I'd like to understand the impact we've seen on the capital markets in Ghana.
Well, from the stock market to the fixed income market, we've seen various degrees of impact. On the stock market has been on a downturn. I must say that this downturn did not start as a result of COVID-19. The losses began way back in 2018 when there was a emerging market and frontier market sell-offs, and that has carried through because of the financial sector reforms that we had and the impact it had on investor confidence. Now, COVID-19 has only come to weaken the market sentiments further. And so currently, the market has lost about 12%. Now, interestingly, what you will notice with the stock market is that historically, the financial stock index tends to move ahead of the composite index, so that when the market is rising, the financial stock index rises faster and vice versa. But what we have right now is that the composite index is moving ahead of the financial stock index. And one explanation for that is that COVID-19 is hitting other sectors of the economy. And so listed companies on the market are also dragging the market beyond what the financial stock index would have told you. Now, on the fixed income market, because of the elevated risk of the market, we initially saw a spike in yields on the fixed income market. However, when the central bank started injecting a lot of liquidity on the market from mid-March, yields have corrected downwards, and we saw a sharp decline from the front end of the market down to the mid of the yield curve as well as the back end. And we think that yields will remain a little depressed from between 19% to around 21% to ensure that there's also an ease for domestic financing of the government budgets.